Hey guys, Michael and Max here with the Mortgage Hotline. I just wanted to take a couple seconds and talk to you about investor loans. There's a number of different types of investor loans. There's anything from a conventional investor loan, and that's where you document your income and assets like a traditional mortgage. We're going to need 2 years of income, 2 months of assets. Ratios are going to have to work, and it's going to have to be essentially a very clean file with, no issues or hiccups on the file. So that would be like a conventional mortgage and a conventional investor mortgage. So then there's a number of different non-qualifying mortgages that are suitable or beneficial for investors. If the property's in good condition, there's nothing weird about it, doesn't need to be rehabbed or something like that, we've got a lot of rental related programs. One would be something called debt service coverage ratio, or DSCR. A debt service coverage ratio loan is going to actually use the rental income associated with the property to cover the new mortgage. So the cool thing about this program is if you're self-employed or you're an investor with difficulty documenting your income, then this is the loan for you. Now, obviously, the loan is going to require a slightly larger down payment, and that's going to be par for the course. The more exotic the loan is, the bigger the down payment. And that's, obviously, those things are risk-based, and you're going to have things like risk-based pricing as well. So we've got our conventionals, we've got DSCR. There's also bank statement loans, and these are typically for self-employed borrowers. Bank statement loans can be used for owner-occupied all the way through non-owner-occupied. But bank statement loans are essentially, we average the deposits in 12 or 24 months of bank statements. There are some other options. There's even some programs that'll do 3 months of deposits. But, then again, there's that risk-based pricing thing as well. And then they use a multiplier based on the expense of your self-employed income. Typically, it's going to be 50%, so the average of 50% of your deposits. But with a CPA letter or some creative accounting, it's certainly possible to do as little as, even 15% of an expense ratio, meaning you would be able to use 85% of your deposits on a bank statement loan. So then we get into the more, traditional investor type loans, which would be like a fix and flip or rehab loan. And that's where the house is in bad condition. We buy the house with the intention of repairing it. And these are usually short-term loans that you either sell the property to get out of the loan at the end of it, or you refinance at the end of the loan if you're going to keep the property as a rental. There are very few, but there are some what are called fix and rent loans, where you can buy the house, renovate the house, and the end loan turns into like a rental loan with a slightly better interest rate, and maybe interest-only features, things like that, to maximize the investor's cash flow. So on the rehab loans, a couple different flavors of those loans. There are typically going to be your institutional hard money loans. Institutional hard money loans are actually a mortgage company that typically specializes in lending in that type of an environment. They are often hedge fund backed, sometimes bank backed, but they tend to be slightly more niche-y. In other words, they may be focused on we have to have great credit, or they're going to have a sort of a standard set of guidelines. And then last but not least, the most sort of liberal version of investor financing is going to be your private money loans. And we do have many outlets for private money loans. So a private money loan is literally someone who's got some money and they're willing to put together a financing package. So you would contact us, we would collect some basic information, run some valuation models on the house, and put the thing together, present it to 3, 4, 5, 10 private lenders, and see who likes what we have to offer. Everybody's got obviously different thresholds of risk tolerance, They've also got different preferences and sizes. One of my more common or popular private money lenders that I work with actually prefers larger loans because it's a better return for him. And then I have, obviously many who prefer smaller loans. They'd like to be in the, under the $200,000 range. So I'm able to kind of sculpt and organize files for those, custom for those investors. So guys, listen, give me a call if you have any questions about investor financing. If you are an investor or are looking to become an investor, give me a call, 407-732-0110, extension 707, or message me on Facebook or Instagram, YouTube, whatever, and I would be happy to share the process with you. Email is michael@mortgagehotline.net, net. So Michael, and that's Michael at mortgagehotline.net. Have a great day, make some money, and we'll see you later, guys.